Thank you so much, Ulf. I really appreciate you sharing all the insights. The whole three-phase model of building focus, then finding the right pivot, and then targeting expansion, I think is probably a good framework to look at how M&A strategy kind of fits in overall. In fact, at this point, I would like to invite both of you, both Chris and you, to come and join us for the open house session. I would also like to invite Michael Lim, who has been patiently waiting with us on this call. Michael is the general manager for acquisitions at IBM Automation, and he has over 20 years of experience within the automation space. And all the recent acquisitions that you hear, like WDG or MindBenio, he's been the man behind making the acquisitions happen for IBM. And in fact, all of our conversation with Michael in the past, whichever company name we have shared with him, chances have been that he's already looked at that company, right? So he's like this encyclopedia of automation companies, if you will, and he has been very passionate about this space. So Michael, if you can also, before your keynote, if you can join us for this open house session, I would love to get some responses and some experiences from you through the questions that our audience is posing to us.
Absolutely. I mean, I would say these two presentations have been fantastic. So Chris and Ulf, thanks for sharing your insight. It's interesting because I have to think about doing this when I do M&A for IBM, and everything that you said was spot on. I loved Ulf that you were talking about change management. That's always challenging. I always feel, and IBM's such an established company, been around for over 100 years. I always say to change IBM, it actually happens through an acquisition. I would say the Red Hat acquisition was a huge change. As you start thinking about ARR and moving to that model, we were traditionally a perpetual license business, but that has really helped us get into a new wave of thinking of the way customers want to acquire technologies within their infrastructure. So this is great.
Perfect. So why don't I pick that one itself, Michael, and maybe I want to start with my first question, right? So if you look at the common thread between Ulf and Chris, right, they are all representatives of companies who are backed by private equities, right? IBM is a giant in itself, and as IBM has been around, you are backed by public equity, right? Mm-hmm. I think the question really is, and this is my assumption, right? In private equity world, you're always constrained, right? You're always looking at a model where the PE is really looking to change hands in the next 3 to 5 years. And therefore, they are oftentimes not very bold with respect to acquisitions that can only deliver value after a certain point in time. They're looking at cash, profitable growth, add-on acquisitions, which can immediately generate hard money, right? But IBM, I'm assuming, is different, right? So if you want to give us a little bit perspective in terms of how a company like IBM looks at investment thesis in comparison to how a private equity backed player would look at the investment thesis. I'll let Chris and Ulf also chime in with their opinion, but Michael, it'll be good to get started with that question and then we go from there.
Sure. So yeah, we do look at it differently. You know, our goal, and I was looking at Chris's note of how much you paid and what's the ARR that you're actually gaining. We look at it a little bit differently because for us, we're not about customer growth as much because we have a very large customer footprint. If I look at automation in both IT automation and business automation, we're the largest, company that provides services for all of our customers in those two spectrums. When we do M&A acquisitions, it's really focused about meeting the needs of our customers. And what we're seeing is we're attacked in a couple different fronts. We're attacked on, small startups that actually come up and try to take pieces of, different projects within our business. Vice versa, we're also attacked in the open source community. And open source is a huge fuel for us to understand. And the Red Hat acquisition was very pivotal for us to really look at it, monitor how do we become not only just acquisitions of technologies, but how do we feed it back into the open source community? And so we think of these investments more long-term. It's not about, hey, making profitability within the first 2 years. It's really about how do we transform the community? How do we get an open source community start thinking about these technologies to drive more transformation than drive just profit? Because that is what's going to fuel the market. And for us, I think that the efforts that we're doing also fuel our competitors in the space. I would say Microsoft takes huge advantages of what we're trying to do around the open source community as we tap into that market. We also see that in some of these smaller startups. that provides justification of why they exist. In our view, we want to view it as a unified platform that is not only meeting the needs for our customers, but giving innovation to our open source community so they can actually create new concepts, new ideas. And every 3 months, we sit down and we talk to our open source community and get some input on how they're leveraging the technologies. What should we be adding into our platform portfolio to give them more value as they deliver to their customers?
Sure. Chris, you talked about growth, consolidation, technology as the framework, right? Given the private equity backing, right, to our audience, right, who are all looking for people like you to acquire them or partner with them, etc., how should these smaller companies think of a player like you, which is backed by private equity, right? So what's the investment thesis that works very well in scenarios like yours?
Yeah, it's a good question. There is a lot to unpack there, but at the end of the day, you tell me how a person or an organization is incentivized, and I will tell you how they're going to behave. And so public equity, Michael, like absolutely, you do want the share price obviously go up over time, but the Business Roundtable, right, 2.5 years ago basically said that, Michael, as a public company, your job as a corporation is not to just deliver value to your shareholders, but to all stakeholders. And that was really significant. And from that, I think, is where you all of a sudden got the push at the board level now around ESG movements, right? So the environmental, the government, the sustainability, and like that actually matters now and goes into is Michael making acquisitions that helps IBM be a good global citizen? As a company, are they treating the communities they serve in right? Are they treating their customers right and their shareholders? And so I think that matters to us when we look at acquiring a company. Now it's not just about the numbers. It's, are they going to add to this culture that we now need to sort of stand for, because that's part of the valuation of the company. Now then you get to the other portion, which is the timing. And you're absolutely right. The average holding period for a Thoma Bravo portfolio company is 3.3 years. Now, some go longer. Highland has been in the portfolio for, a dozen years. But then you've got the Ellie Mae that was bought for, $3 billion and sold for $11 billion within 18 months. And so you do have some shorter term sort of gains that Thoma Bravo will realize. For the smaller companies that are looking to be acquired, and I was talking to a CEO of a smaller company yesterday, and that's what the call was about, basically him just reaching out. So I would say take the initiative to reach out, because companies like Kofax are continuously looking for. And so if you come to us as opposed to us having to search through, then that makes our job that much easier. So we actually want people to reach out to us, CEOs to reach out to us. What I would say is, and there was a question in the chat, so I'll preemptively address that, and it was around sort of the valuations tied to software licensing and services. We frankly want to see services at 10% or less of the business, especially in a SaaS go forward model where you shouldn't need to provide as much implementation services. So what services are you really providing? So if majority of your revenue is around services, that is not recurring revenue and isn't the quality of revenue that we're looking to acquire at this particular phase, because it is not helping us with valuation. It's actually hurting us with valuation. So if I was a small business right now, I would be looking to get away from the services revenue, outsource that through your partner community and focus on software and focus on ARR, GRR, gross revenue retention. So how much churn do you have? Are you keeping your customers happy? Is your product sticky? And net revenue retention. Are you able to sell them on more consumption and more add-on technologies over time? Those are the three key metrics: annual recurring revenue, gross revenue retention, and net revenue retention that we look at.
Perfect. I already see a lot of questions coming in the chat window. I'll pick one by one, all of them. But before we do that, Ulf, just from your perspective, we have several of these CXOs from different companies join us today, right? The classic dilemma that companies which are relatively smaller, they always face is, should I sell now or should I wait, right? So what is your advice to people who have joined us today, right? When is the right time to decide to sell, right? What has been your experience looking at it from the other side? What piece of advice you can give to our audience today?
Well, it's an interesting question because it's almost impossible to answer, of course. But I think what I've seen actually in my role as Abbyy and before as well is it's the the most interesting and valuable companies are the ones that do not want to sell. So they are the ones who have a very clear strategy. They're executing well. There may be a really good fit with yourself, and you have to sometimes pay a very strong premium to release them of their asset, if you will, or to ask them to join you and your family. And my experience is that the best deals are typically the expensive deals. So you actually pay a premium for something that is really good and quality, but in the longer term, it's going to pay off. So my advice would be focus on your strategy, focus on your execution. When you do well, there will be opportunities. I think there's a slight tendency, or maybe even not even a slight. There is an overly strong tendency in the world today to focus too much on the end game rather than how to get there. So I want to become a rich person. How can I become a rich person? I don't think that's the right approach. I think that what you should do is do what you're good at, do what you enjoy. If you have a really compelling use case, a really compelling solution, a really compelling technology, run with it. Run with it. Seek funding if you have to. If you don't have to, don't do it. And you will then be presented with a lot of good opportunities because companies will come to you, investors will come to you. Now, obviously, you need to market yourself. You need to make yourself visible. But in today's interconnected world, that happens anyway. Because if someone is working with PwC and we're working with PwC, we will know that there is this company. Why don't you just go and talk to them? Or there's a banker, or there is an enterprise customer. So I think focus on what you're good at. I think that would be my core advice.
Perfect. So all three of you have given us at least one good takeaway. Michael talked about investment thesis from a community expansion, community engagement standpoint. Chris talked about prioritizing software over services and look at NRR and NDR and all of those GRR parameters. And then you are talking about really in terms of focus on the journey and not the destination, right? So I think some great takeaways there. I would invite very quickly, I think maybe Frank Cassell, you had a question for our audience. So let's make it interactive. If you're comfortable, switch on your video and go for your question. You can also maybe quickly introduce yourself and then ask the question.
Oh, no issue. Thank you. Great presentation, gentlemen. And good to see you, Chris. And guys, congratulations on your success. By the way, Ulf and Chris, behind these stories are very successful companies and awesome teams that you have. So kudos to you. I'm just curious, as you compete, as your company competes for customers, the competition for acquisitions is probably as much or even more of a challenge, right? You have a really hot market. You have a whole bunch of companies, some of them on this call, chasing after a small handful of attractive companies, and you have a war chest of money out there. So I'm curious if how do you deal with that? And this is a related question, which is one of the things you're doing, considering moving in earlier, maybe grabbing younger companies before they become too popular or before someone else finds them.
Yeah, Frank, no, great to see you again too. It's been too long, my friend. But so a couple things there. I agree. For us, it's not going to be pre-revenue companies. So we're not an angel investor, but if you look at our last acquisition, it was exactly what you just said. Because the environment is so competitive, we had to, and we typically go across the pond. So we go to EMEA because the valuations there are more reasonable than in the Americas. And so a lot of our acquisitions has primarily been in the Nordic region. And so we made an acquisition last month exactly that way. This is a company that the business case was to scale it to basically a $100 million business over the course of the next 3 to 4 years because we saw the potential in the technology. And And so that was the first part of it. And to sell a private equity company to allow us to make that acquisition was not easy. They basically said, hey, you've made enough consolidation acquisitions that has created so much value that we'll give you this one. Because obviously we're going to have to invest in this one. So again, not every acquisition is the same. So we get maybe 5 good consolidation plays, and then we get a pass for a growth acquisition play. And that's what happened in this one. So you're right. You do have to look for these diamonds in the roughs, and we hope it's a diamond in the rough. Time will tell. But then there's the piece that I think a lot of people don't want to talk about. And that is, again, you tell me how a person is incentivized. I'll tell you how they're going to behave. So it's connecting with these CEOs that maybe it's the first time they're going to cash a significant check. And that matters to them because it may not be what some would say like the FU money, but it may be pretty close to that, to where they can really decide, do I want to stick around or do I not? Do I want to go on to, be a serial entrepreneur and follow my passion and create something else? What I have found is that a company like Kofax, we're at a position where we can offer some significant options that obviously vest over time, so we can keep them tied to the business to help us, integrate it or scale their business using Kofax sort of shared services, if you will. And that's how we typically get both the technology and the right IP, intellectual property, and the talent to be able to scale these businesses. The consolidation plays, we're not looking for the talent, right? We're looking for just the financials on it. But you're right, we have to get really creative here. And for some of these small businesses, it's the first time they're cashing a significant check. And then we offer them, 4-year vesting where it's 50-50 in terms of performance tied to EBITDA, annual EBITDA, it vests. And then the other 50% is tied to time. And so they're incented to stick around and be collaborative with the management team in order to drive the top and the bottom line.
Great, thank you.
Right. Nazar, you also had a question, right? So if you want to ask a question, if you like to come on video.
Yeah, sorry, I'm driving right now, so not able to join on video, but great presentation so far. Thank you, everyone. I have a quick question about how to basically be on your radar for an acquisition, how to reach out to you just to talk about the potential acquisition. You said the best companies are not willing to sell, but would you be able to jump on a call or start a conversation with a company that just will reach out?
If the question is to me, absolutely, I'm more than happy to do that. So I'll put my my email in the text chat later on. When I said that, and I stand by it, but that doesn't mean if you marry that with what I said in my presentation, I think a very good way to both mitigate risks. And that risk actually from both sides. You don't want to sell a company and then something is not going well. It's your baby. You invested a lot of money, time, and resources, and more than anything else, your own emotions. So you want your baby to succeed, right? So to mitigate risk from a seller point of view, as well as from an acquirer point of view, if you get to know each other through collaboration, through partnership, through technology partnerships in a solution building or whatever it is, I think that's a very, very good way to start on the path to what might become a very successful acquisition. So that's what we're doing with a lot of companies. And I think it ties into what Frank was saying right now. The question is, how can you afford in a very hot market? Well, I think you need to start by asking yourself, what is you trying to do? What does your customer do? How can you increase your value in the eyes of the customer with the additional technology or the additional product or whatever it is that you're acquiring? And then you sort of count backwards and say, can I do this myself? It takes too much time, or I'm not good enough, it's not my area of expertise. But if there's enough value on the customer side, well, then maybe you have to pay those top dollars and just swallow that bitter pill. But as I said before, it's the price in itself is not necessarily driving. What is driving is what comes out at the other end, how much it drives customer value and drives ultimately then shareholder value. But tying that back to your question, Nazar, I will really believe in sort of tying the knots early on and go forward together. And then along the way, you will figure out, is this something for us or is it not something for us? And that goes both ways.
Thank you.
Perfect. So, Michael, at this point, one question for you, right? As we're talking about these discovery of companies and companies trying to reach out to others, how important is it for these assets to be introvertish or extrovertish? In the sense that, should they be doing a lot of marketing? Should they be out there really? Should they be focusing a lot on creating customer stories that are made public? Or should they just be heads down on improvising the technology and not get distracted, right? So how would you advise these companies in terms of finding a balance between being introvertish and, to Ulf's point, do what it takes to build a company, or kind of celebrate extensively the small success that they make and be out there in the market? What is your observation and advice to companies in that sense?
Yeah, I mean, so when we were doing acquisitions, I really look at a synergy in the story of what we're trying to go and drive. And you can only see the synergy through the customer case stories that you have. And, I always say in customers come first. We listen to the stories, we look at the impact that they're making into the market. And then we make a determination, is that aligned to the story of where we're trying to grow and where we're trying to reach out, and we tie them together. I find that most of the companies that we've acquired, I really focused on their stories, their capabilities, but I knew over time the capabilities are going to be thinking in a broader sense. Like if I just bought a company and it was just, let's say, I bought the RPA company and all they're doing is RPA, well, that's great, but I'm not in the RPA business. I'm actually in the hyper automation, the intelligent automation business, of which I need to figure out how that ties to the other componentry to give a holistic platform, right? And in what we do is, when we do an acquisition, we make considerable investments to help align that story together. But the only way I can see that is through their customer case stories. Where are they transforming, moving away just from the core capability that they have across this concept of truly driving hyperautomation? And that's really where we look for in a story. I mean, I evaluated probably 20 RPA vendors before we went and acquired them. And everyone I would go to the meeting, and it's funny, all the presentations are the same. It was literally the same presentation, but just different logos on the side. And that wasn't interesting for me, because I wanted to see, what were they trying to do? What impact were you going to try to make? And most of the CEOs that we have that have stayed on, because they weren't about the money. You're right. As Chris said, you can get your FU money and you can be happy. But most of the CEOs that we brought on board were CEOs that said, I want to be a legacy. I want to drive a legacy. And I think I can drive a bigger legacy if I'm a part of the IBM ecosystem versus being a standalone offering, right? And that is what we look for. We look for people that are thinking bigger than what they have, thinking the art of the possible of how they can grow, and then coming to us and say, yes, not only do we want to sell you this technology, but we think that we can transform the way that you're driving your hyperautomation strategy, because we're an element that adds to it, that adds that incremental value that your customers will actually see.
Great, perfect. Thank you. I think John has one question. I'm not sure. John, are you able to come on audio, or I can also read the question for you if you like?
Due to background noise, please go ahead and ask for me.
I think you're perfect. Your background, there's no background noise, so you can go ahead.
Okay, great. The comment was made earlier about re-platforming, or at least modernizing, I should say, some of what you guys already have as fairly platforms that are already 10 years old and continuing to grow, and you're putting a lot onto those. But at some point, I always imagine the innovator's dilemma has to come and play, and you'll be thinking about how you really do modernize at the platform level. And I'm wondering if any of you guys are thinking about that and what it's going to take for you to potentially transition customers from one to another. Are we at that state in this market yet? Or is that going to be something, maybe someone else is going to be disruptive and that's going to cause it? I just wonder about that kind of idea.
I think I may start there. I think that's a great question. And I think that is one of the things that would keep me up at night. It's how do you stay relevant? And I think the only way to stay relevant is running faster than everyone else. So what we try to do is to acquire a new set of technology, or I wouldn't focus too much on the technology, because it's a capability, and then it is how it is delivered. Cloud is not enough. It's going to be no code is easy to use, easy to deploy. It's going to be completely flexible and work with other platforms. So when we acquired Timeline, that was what it could do. But also the same with our core IDP capabilities. They've been completely re-platformed or revamped. So what we call Vantage is an entirely different kettle of fish than the old FineReader or FlexiCapture. So in that respect, I would rather say that we have completely reinvented the way we do business. And that's when you saw my slide earlier on, you can't just change a product or a platform or a technology delivery model. You have to change the mindset, because you're selling a different thing. You're selling to someone else. You're a different company all of a sudden. And to me, perhaps that has been the biggest challenge. And frankly, what has made me most proud over the last few years is we have to a large extent, we're by far away not perfect. We're not even close to perfect. But we've come such a long way to actually completely transform the mindset of Abbyy as a company, who we are, what we do, and for whom.
Awesome.
Yeah, real quick on that, because I think so Kofax has been around for some time. Our latest acquisition was exactly this innovator's dilemma that John was calling out. So I love the question, because you're right. For mature companies, you have to constantly be thinking of that build buy decision. And based on the accelerated rate of change right now in our industry and the expectations of customers, you frankly don't have time in most instances to rebuild anything. You've got to sort of place bets on an acquisition and then smartly transition off of the old and onto the new. And that sounds easy, but it is extremely difficult. And it can be extremely time consuming and expensive to both protect your base and position for the future. And so balancing that is essentially, I think, why I was asked to come in 3 years ago when Thoma Bravo bought Kofax, was to do exactly that: position around the future, but also protect the existing base, because we had a lot of revenue, maintenance revenue sold based on perpetual licensing that we could not put at risk, but yet we needed to be more cloud native and not just say our technology is cloud ready. And Ulf, I think that's where you were going with your new push in the market, is that I think a lot of old companies, and Kofax is in that group, I think what you have to be careful with is when they say, well, we've got, cloud ready technology. If you look under the hood, it's very monolithic, the architecture, and it's clunky. And so they do have to make investments. And that's what we frankly did with this new small business, which is cloud native, not cloud ready. Huge difference. Mm-hmm. And so that's what we're looking for. So any startup on this call, if you are not cloud native, then I would sort of question like the valuation that you may have in, like the number you may have in your head, because cloud ready just isn't enough for us to actually look at companies on a go forward. Because we know cloud ready is going to result in a low GRR a couple of years from now, because it's going to result in a lot of black eyes, poor implementations, long lead times to get to value. And that's going to result in customers churning out and latching onto a SaaS solution. And therefore it's going to hurt our valuation. So we are looking out for a couple of years in terms of what those key metrics need to be. And again, there are only a couple high level key metrics. And if those metrics aren't where they are, then I can very easily double click and realize that, okay, you don't have a customer experience program. You're selling stuff, but you're not catering to the life cycle care that a customer needs. So I know I talk a lot about financials, but frankly, in private equity, those numbers don't lie. You can say like you love customers and everything, but if your GRR is below 90%, you're not doing it right. Mm-hmm. And so this is where private equity is very numbers driven, because numbers don't lie. And if they do, then it's called fraud and you've got a bigger problem.
Perfect. So I know we're waiting anxiously for Michael's keynote, but one last question will quickly go across the board. Michael, maybe I'll ask this to you the first. You're all known as master negotiators, right? When you buy companies, you're really, really negotiating hard and getting the maximum value that you can. But for a moment, we are a hat of these startups, right? How would you derive more value from companies like Abbyy, IBM, and Kofax if you are one of those? What is your advice to these companies to improve value, right? So Michael, if you can give your opinion on that, and then Chris, and then Ulf.
There's a couple different variables that actually I look at, in companies that drive value. I mean, one, as I mentioned to you, it's the customer stories. Everything is about the customer and how quickly you can get the value. I like Chris and Al's perspective about SaaS. The 2 acquisitions or the 3 acquisitions we also acquired, Instana, was all SaaS based. That was one of my criteria, because we're moving away from selling licenses based on cores, or moving away from that model. We're moving to a more of a as a service model. And we want to make automation a utility, just like your electricity is a utility. And so it's really important for us to look for companies that are moving into that model where you can price per minute and you can drive it, where customers see immediate value when they use it. 2, I look at SaaS companies because I want to have a no install experience. I want it to be ready on the go. People get access to it and they're able to go and derive value from it. It's got to be organic in the sense that companies, when they take a technology, not only their IT organization, but their business organization, can use it as the technology as a vehicle to drive collaboration. Because I don't see a lot of IT and business organizations really collaborating to solve the automation problem, because I don't think the problem is business or IT. It's actually a mixture of both. And so, when I talk to a company that wants to drive more value into their business if they want to get acquired, it's really about the stories. How are you bringing it? Where do you see your technology going to kind of drive growth for customers and adoption? I don't want to buy a company that's going to be adding to shelfware into the company, because it doesn't get used, and then our customers don't see the value they get out of it. And so when we went in and negotiated exactly the cost of what we're going to pay, you're right. It was really around that. Tell me your stories. Who are you impacting? What is your reach? How can we go and drive more? And that helped me justify what the cost is.
Sure. I think Alexander is asking a very related question. So I'm going to use that to go to Chris, right? So Chris, I think the comment really that Alexander has is that instead of acquisition as the only route, is it kind of an interesting strategy to also partner before you get acquired, right? So that allows you to get to know the customer, the company better. That also allows you to, like Michael is saying, form the stories better, right? In terms of what you can do for customers and how the future roadmap could look like. So how open are companies like yours to first forging partnerships and then using that as a pipeline for acquisitions?
Yeah, I would say it doesn't happen often, because I think with smaller companies, the difficulty is, can they support on a global scale their product? And usually the answer is no, because they're smaller in nature. And so we typically don't go that route. I can tell you, like, there are specific instances, and I'll give you an example, where a company is specializing in machine learning pre-trained models around specific use cases that maybe allows us to use an API call to their at-ready library in order to accelerate the time to value for our customers. An example would be around, say, mortgage onboarding process. So we've all sort of bought a house before, and when you do that, there are so many documents, and each one of those documents, if it can be automated via a pre-trained library, then great. And if it's a gap that we have, then there's something worth considering. And maybe that's the courtship before, could we take this to the next level? But I will tell you, especially with, and Michael talked about the open source. I mean, we're frankly getting in bed right now with Google around exactly this use case. And so I think the whole open source and Google, frankly, making a lot of these AI services for free, it's requiring that the entrepreneurs that are starting up companies be really savvy, because you've got these open source AI services now that are marrying up with companies like us and offering it for free. And you know why Microsoft and Google is doing this? To drive Azure and Google public cloud consumption, period. So they're offering so many of these services just to drive cloud consumption, which I think is nudging out a lot of the business ideas in the smaller, entrepreneurial community. Perfect. I know we're running out of time, but that's a very good point you made about open source and why the entrepreneurs have to be savvy. At this point, Michael, would love to hear your perspectives and experiences at IBM, and where do you see the market at it? So if you don't mind sharing your presentation and give us a quick rundown of your journey, I think that'll be really awesome.